I want to give you a quick little lesson on adjustable rate financing, because this is how the commercial loans work. I am not a fan of adjustable rate financing, but you do need to have just a super quick understanding of it. This is easy. It's no big deal. It's just a quickie thing. And when you do an adjustable rate loan, there are 5 basic elements of it, okay? There's the start rate, and that's otherwise known as the teaser rate, okay? And on these commercial loans, that is probably going to be fixed for 5, 7, or in rare cases, 10 years, okay? Then there is the index, and the index is what the loan is tied to. So after the initial fixed period ends, then you take the index, which might be the the cost of funds index or the prime rate or whatever. There are many indexes, okay, or the LIBOR or whatever. And then you take the index plus the margin. Now the margin is, a profit above the index. And when you add the two together, you get the true fully adjusted rate. So if the loan starts out at 4%, and then the fixed period ends after that starter teaser rate, and then the index is at 3% and the margin is 2.5%, how much will your fully indexed rate be? It'll be 5.5%. Okay? So you understand that. And then, in addition to that, you have a lifetime cap, and a lot of times this is it, because the lifetime cap just tells you the maximum interest rate during the life of the loan. So that might be 6% above the start rate or something like that. These all vary, okay? And then sometimes there's a payment cap, but you don't have payment caps too much anymore because you really don't have negatively amortizing loans too much anymore, and that's when you had payment caps. And a payment cap would kind of become important when the fully indexed rate, which is the index plus the margin, was not allowed to go up to its full amount in terms of the payment, because they would only allow you to pay a certain amount more each year to avoid payment shock. But then the balance of the index plus margin and that fully indexed rate would negatively amortize and actually increase the borrower's loan balance. This became very unpopular after the financial crisis, as you probably know, okay? So you're rarely going to encounter that. But what you would encounter is, instead of a payment cap, an interim cap, okay? Or an annual cap maybe, or a semi-annual cap. And that will be a cap based on the rate, okay, rather than the payment. So it'll say that, your index plus margin might say it should be 5.5%, but because the start rate was 4, and this is just an example, the numbers will vary, and your annual cap is, say, 1%, then you could only go to 5% when you should be at a fully indexed rate of 5.5% in the example I gave you. And there would be no negative amortization in that case. Does that make sense? I just wanted you to have a little quick understanding of adjustable rate loans. It's not a big deal. You won't encounter them much. The only time you should be doing an adjustable rate loan is on the commercial financing. On the residential financing, always get a fixed rate loan. The rates are so low nowadays, it's a great way to go.